guys, welcome back. My name is Natisha Paramasubam. I'm the Senior Wealth Advisor and Director of Gold Tree Wealth Advisory. We're a financial planning business based here in Melbourne. Today I want to talk to you about how we all could be saving a little bit of cash. We could be saving for school fees, holidays, maybe getting into the investment game and buying some shares or property. We obviously need some cash to do that. And a great way of saving up that cash is to look at saving things that we didn't even know we're spending a little bit too much on. So the first thing we could be looking at is our insurance policy. So a rule of thumb is that we should, at the very least, be reviewing our insurances every 2 years. So your insurances could be income protection, your home and contents insurance, your car insurance, whatever that may be. Always have it reviewed so you know that you're paying the best price for the most comprehensive policy out on the market. And one way of saving some cash on our insurance premium is to pay for that annually. So by paying for your premiums annually, you're probably saving somewhere between 5 to even 10% on your premium. So it's a good way of saving a little bit of cash if you can afford to pay for it as a lump sum up front. But the other thing is, say some of us have gotten into insurance policies and we've paid for it annually, more times than not, we don't have to wait until that full year is over before we can actually review our policies. A lot of us aren't aware that, again, you've got to check with your policy provider, that if you decide to cut it halfway, you actually get refunded the period that hasn't been used. So, for example, I got into an insurance policy in January, now it's the end of October, and I decide to cancel. The 2 months that are left over, which is November and December, will get refunded back to me. But make sure you call up your provider and double check that. The other thing you can look at doing is bundling your policies. So if you have car insurance and home and content insurance, you might be able to bundle them to save 20% or even more or less depending on your insurance provider. So bundling is a great tool. But also keep in mind that when you bundle, you want to make sure you still have good policies. Just because you're saving a couple of percentage here and here, you might be compromising the type of policy that you have or the quality of policy. Either you do it yourself or give us a call, we'll be able to help you with that kind of stuff. Other thing you should be looking at is online savings accounts. So a lot of people might be a little bit wary about online savings account, but typically a lot of the online account providers are government backed. So that means that up to $250,000 that you put with them, it's basically protected by the government. But you need to do your research on that. They usually would stipulate that, but go through their product disclosure statements as well as independent research that you can find, or email us and we'll double check for you. The other thing you can look at is if you have a mortgage, you should be reviewing your interest rates constantly. And if you have a fixed term period, don't worry, you can still review it early. A mortgage broker will help you out and give you advice on whether you can exit early without huge penalties. So if you email us, we've got a broker network that we can refer you on to. But the reason why, because if it means saving 0.5%, that could be a lot of money on your loan. Again, it depends on the value of your loan. But you should be reviewing your interest rates all the time. If you don't want to go through a broker, you can do it yourself. It's very simple. You walk into another bank, you feed them your scenario, you ask them how much they would provide as an interest rate on your loan. And then to save you doing the paperwork of having to change, go back to your bank and say, hey, bank number B is offering me this interest rate. Can you match it or beat it? And chances are you might get lucky and they might be willing to come to the table and either match or beat your interest rate that you're getting offered at the new bank. The other thing you should be looking at is where you're saving funds. I have clients who have a mortgage and an offset account linked to their mortgage. At the same time, they've got all these other external accounts. They might have a holiday fund, they've got a kid's education fund, which is fine, and I love that. I love that my clients are trying to save and get ahead. But this is the thing that happens when you've got these accounts happening. So when you have a loan and an offset account, and you had all those accounts sitting in that offset account, you're basically saving 5% in interest on your loan. But these accounts on the side, if you had funds sitting in there, they're earning you maybe 2.5% in interest. So it becomes a question of, do I earn 2.5% or try to save 5%? It's almost double. So in this scenario, it is more beneficial to have those external accounts just amalgamated into your offset account if you have a loan. Some people prefer to have those external accounts so they don't touch it. But when it comes to numbers, obviously it's more beneficial to save money by having funds sitting in offset than an external bank account. Anyways, guys, I'll bring you so many tips down the track. For now, I'll leave it here. Thank you so much for watching. Please subscribe if you haven't already, and until next time, I'll see you again. Bye!